Hello, everyone. Good afternoon, and thank you for joining us today. I hope you and your families are safe. This is the webinar on MNES, how to benchmark and document FY20 transfer pricing report in light of new tight deadlines, where my colleagues Douglas and Becky will cover transfer pricing impacts related to compliance and practical guidance on benchmarking and document transfer pricing reports in light of COVID-19. We're also delighted to announce that we're unifying the Duff and Phelps brand under the Crow brand this year. The Crow name will help us deliver a more integrated experience for our clients and prospects while supporting a united, aligned internal culture. The change is grounded in internal and external market research and will position us for long-term success. The Crow name carries strong brand recognition globally, which complements our expansion outside of the US. The valuation business will continue to use Duff & Phelps, a Crow business, as an endorsement strategy for a transitional period. We appreciate your continued patronage and hope this brand transition continues to provide more opportunities for our team to serve you in the coming years. This is a listen-only webinar. If you have a question, we encourage you to ask them through the Q&A widget. A recording of this webinar will be available on Crow's website in approximately a week from today, and a link will be emailed to all attendees with today's slides. And now I would like to request Douglas to kick off the session by setting some context and going through our agenda for today. Over to you, Douglas.
Thanks very much, Summer, and welcome everyone. Good afternoon. Just to give you some background information about Duff & Phelps before we get into the substance of the presentation today. Hold on. There we go. So about Duff & Phelps, a Kroll business. Duff & Phelps has been in existence for nearly 100 years. It's now part of Kroll, as Summer described, which is the world's leading provider of services and digital products related to governance, risk, and transparency. We have nearly 5,000 professionals located in around 30 countries and territories around the world, including over 850 professionals in the Asia-Pacific region. And we serve around 13,400 clients, including almost 48% of the Fortune 500. Although we are, let me get to the right slide, there we are. Although we're perhaps best known as the largest independent valuation advisory firm in the world, we offer deep and real expertise across a range of services. So valuation advisory services, that includes transfer pricing. Corporate finance includes M&A advisory, fairness and solvency opinions, and transaction advisory services, for example. Governance, risk, investigations and disputes includes things like business intelligence and investigations, compliance and regulatory consulting, compliance risk and diligence, cyber risk, and disputes consulting. And last but by no means least, business services, which provides a wide range of services, largely in the US. As mentioned, our history dates back nearly 100 years, growing both organically, obviously, but also through a number of acquisitions over the years, and those are highlighted here. Also, as mentioned, we are now located in around 30 countries worldwide, and we have 17 offices in the Asia-Pacific region, including one in Malaysia. We are the largest transfer pricing group outside the Big Four. and we pride ourselves on being a truly global and coordinated team, able to serve multinational clients of all sizes in all regions and operating in all industries. We offer low leverage, partner-led engagements with a focus on providing high quality, practical and strategic transfer pricing advice, with a focus on the local nuances and developing defensible global policies. Since we don't provide statutory audit assurance services, we are independent and not subject to the same onerous audit, tax and regulatory restrictions of our Big Four competitors. We provide the full range of transfer pricing services to our clients, covering design and planning of transfer pricing systems, including benchmarking of all related party transactions and setting of price setting policies. Preparation of the documentation of those systems for compliance and other purposes, and defense of transfer pricing practices in the face of tax office scrutiny all over the world. Your presenters today will be Douglas Fohn, that's me. I'm a managing director based in the Singapore office and leader of the transfer pricing team in the Asia Pacific region. And Becky Nguyen, who's a director based in our KL office and leader of the Malaysia practice. First of all, a standard disclaimer that any positions presented in this session are those of the panelists and do not represent the official position of Duff & Phelps LLC. Our agenda today, firstly, Becky will provide an update on transfer pricing developments in Malaysia. Secondly, Becky will go on to discuss the particular issues surrounding transfer pricing documentation and benchmarking for the financial year 2020 in light of the COVID pandemic. Then I will run through the typical operating models from a transfer pricing perspective, and we will finish hopefully with some time for Q&A. So I'll now pass over to Becky, who will take us through transfer pricing updates for the Malaysia market. Just bear with us as we change over presenter.
Thank you very much, Douglas, and good afternoon, everyone. Welcome to our webinar. And under this part one, we'll be sharing about the key updates in terms of transfer pricing regulations and practices in Malaysia. And as you can see, in terms of the Malaysian transfer pricing law and regulations, business would need to be aware of the Income Tax Act, Section 138, 39, 139, 140. It governs the and it provides the definitions about the control companies, and it also empowers the tax authority to disregard transactions if they are deemed not to conduct at arm's length, right? And the tax authorities has powers to substitute the price with an arm's length price that they think fit, and able to disallow the interest if they found that the interest is not charged at arm's length. And under the Income Tax Act, there is Income Tax Transfer Pricing Rules 2012 and the Malaysian Transfer Pricing Guideline 2012 and its updated versions in 2017. And as and where transfer pricing considerations have not been mentioned under our local regulations, taxpayers can always refer to the OECD Transfer Pricing Guideline for additional guidance. And we will be looking at the evolutions of the transfer pricing regimes in Malaysia. We can see that it has been evolving significantly in the past 20 years. For the latest regulations and guidelines, taxpayers would need to refer to the 2017 version's transfer pricing guideline. And that year, there was an adoption of the earnings stripping rules that restrict the interest expense to be deductibles and did replace the teen capitalization rules. In addition to those rules, there was an adoption of the CBCR and BEPS Action 13, under which Malaysia has adopted to require taxpayers to prepare 3 tiers documentations, which are country by country reports, master file, and local file. And in terms of the transfer pricing audit framework, the latest regulations taxpayers would need to be aware of is the transfer pricing audit framework 2019, right? It sets out the new procedures for tax authority to carry out the transfer pricing audit cases, as well as new penalties applicable to taxpayers who fail to furnish the transfer pricing documentations upon request by the tax authority. And the third one we wanted to highlight is the at the tax authority level, they have 2 branches, the MNC branch and the LTO branch, who focus on transfer pricing audit at both multinationals companies level and also domestic companies level. That means that both, international companies and domestic companies are required to adhere to the arm's length principles and follow the transfer pricing guideline. And we wanted to discuss further on the transfer pricing guideline 2012. It has been updated in 2017, and almost all of the changes are consistent with the BEPS action plan. And we wanted to highlight here, Chapter 2 has been updated regarding to the arm's length principle. Chapter 8, there was an update about intangibles, and Chapter 11 is about the documentation. And there was an entire newly added chapter, which is Chapter 10, about the commodity transactions, right? And in the context of this webinar, we'll be focusing on Chapter 11 about the new requirement and update for transfer pricing documentation. Right. The first questions for the transfer pricing documentations for taxpayer is that when they will need to prepare and update their transfer pricing documentation. And as a rule of thumb, the transfer pricing documentations is an annual requirement. Taxpayers is expected and required to prepare the documentation annually. Right, and in Form C, they are required to tick the box to indicate to the tax authority whether they have prepared the documentation for that year of assessment or not. Right, so you can see the update of financial data and review of comparable companies need to be carried out every year, right? And in case there is material change in the year of assessment, the update of the entire transfer pricing documentations, including the update of financial data and the update of the functional analysis, must be prepared again from the scratch for that particular year. And in case there is no material change, the company can opt to update the entire documentations in every 2 years. Right? And in terms of material change, it refers to either operational conditions, the change in operational conditions, or the change in economic conditions. And in terms of the operational conditions, there are examples for you to refer to. For example, change in shareholding structures, change in business model, change in your transfer pricing policy, that all would warrant the operational condition changes. And it in turn would require you to prepare the entire documentations for that particular year. And regarding to the economic conditions, it could be economic downturns, it could be natural disasters that affect your business. And in 2020, particularly, because of the COVID-19 pandemic, it triggered this change of economic conditions. So therefore, 2020 transfer pricing documentation in Malaysia is require all taxpayers to prepare the new benchmarking analysis, to prepare entire new documentations, to document the change and the impact of the COVID-19 pandemic in the business result and in the business process, right? And as we mentioned earlier, under the three-tier documentations, taxpayers in Malaysia are required to prepare 3 reports, the country-by-country report, master file, and local file, subject to the threshold, right? And for the country-by-country report and master file, the threshold is 3 billion ringgit consolidated revenue. It means that not all business in Malaysia would be subject to those 2 requirements because of the high threshold. However, for the last requirement on the local file, this local file documentation would significantly impact almost all business who have intercompany transactions. And it has a threshold, and we'll be presenting those thresholds in the next slides. However, the threshold here is to define the content of the documentation. It's not the threshold for the arm's length principle, right? So meaning companies who have intercompany transactions by right, regardless of the amount, is required to adhere to the arm's length principle. But if the quantum of the transactions and the size of business doesn't hit a certain threshold, they can opt to prepare the limited versions of documentation, right? For example, if the gross income is below 25 million and the total real party transaction is below 15 million, then they can opt to prepare the limited version. Or they have intercompany financial assistance transactions that below 15 million ringgit, they can opt to prepare a limited version as well. Otherwise, if they exceed the threshold, they're required to prepare the full versions of documentation. And in terms of the differences in content of the 2 versions, one which is the full and another one is the limited TP documentations, you can see as we highlighted here. For limited documentations, there are 4 priorities that need to be addressed. Those are the group ownership and organizational structure, the detailed explanations of the control transactions, together with its pricing policy, and it requires detailed explanations for the pricing policy. For example, who set the price and how often the price is updated, and what is the formula for the price. And the last item would be the financial analysis of the entity for the year assessment. As compared to the full documentation here, there are additional analysis are required. Number 1 is the industry analysis, where business would need to set out the context of the market conditions and industry conditions that they are operating in. The next analysis would need to be prepared is the compatibility analysis, functionals and risk analysis, where you document the functions your business perform, the assets that utilize, and the risk assumed by your business. And the next analysis you need to carry out is the selections of transfer pricing method. There are 5 transfer pricing methods that allow you to choose from, and you can choose the most appropriate method applicable to your transactions, to your business. After the selections of method, you need to document the applications of the method into your transactions business. All right. And with that in mind, effective from January 1st, 2021, there are new requirements for transfer pricing documentations in Malaysia that all businesses must be aware of. Number one is a new penalties applicable to taxpayer who fail to prepare the documentations. Prior to 2021, the taxpayer who failed to prepare the documentations would be subject to transfer pricing adjustment upon the transfer pricing audit. However, starting from this year onward, regardless of the tax audit, whether it's open or not, failure to prepare documentation is subject to penalty, ranging anywhere from 20,000 ringgit to 100,000 ringgit, or imprisonment of 6 months, or both. Right, and on top of the new penalty, there's an additional surcharge on the transfer pricing adjustment amount. For example, if your transfer price of revenue set out the revenue at 2 million ringgit, but the RIB deemed that is not at arm's length and substitutes the 2 million with 3 million ringgit, then the transfer pricing adjustment amount is identified at 1 million. And on top of the 1 million transfer pricing adjustment, there's up to 5% surcharge of the adjustment amount given to the taxpayer. So this new surcharge would significantly impact companies, even though they are in loss-making positions or they are given tax incentives, because prior to this requirement on this surcharge introductions, companies in loss-making positions or company is enjoying tax incentive just get minor or limited impact of the transfer pricing adjustment, if any. However, with this surcharge, company would get the surcharge on top of transfer pricing adjustment regardless of their loss or profit-making positions. And this surcharge is unlikely to be treated under any DTA, so it could be a cash outflow to the business. Right. So business would need to be aware of and take a proactive approach on the transfer pricing documentation to mitigate the risk and to avoid the penalties and surcharge on the transfer pricing adjustment amount. And the third new requirements is about the new deadline to submit the documentation. Previously, taxpayers are given 30 days to provide the documentations upon request of the tax authority. However, starting from this year onward, the deadline now is tightened for 14 days only. Right, is applicable to all audit case commenced on or after January 1st, 2021. And in practice, is almost impossible to prepare the transfer pricing documentations within 14 days. It means that taxpayers, business are encouraged to prepare the documentation in advance and have it in place prior to the year. And is able, should be in the position to be able to submit, to furnish the documentations upon request immediately. Right. And the last item we wanted to highlight here is the new penalty rate under the transfer pricing audit framework 2019. Right. If the taxpayer did not prepare the documentation at all, then the penalty rate is 50%. And if the taxpayer prepared the documentation already, but the documentation is not considered as a fully compliance with the guideline, then the penalty rate still apply at 30%. And in some cases, under specific facts and circumstances, the penalty could go high to 100%. All right. So with all of the new requirements, we can see that the IRB made a strong impressions and enforcements in transfer pricing documentation requirement. Taxpayer should take efforts to prepare the documentation before the year end and stay in line with the guideline. And we can have a look at the tax collections in Malaysia in the past 5 years. We can see here the tax collections in Malaysia ranging from 120 billion to 130 billion in actual collections in the past 5 years. And in terms of the number of audit cases, both tax and transfer pricing audit, we can see here during the past 5 years, the number of cases is about 1.2 million cases, right? And the amount of settlement during those tax and transfer pricing audit ranging from 10 billion to 11 billion per year in the past 5 years. It indicates the effort in enforcement of transfer pricing rules and the intensities of tax audit carried out by the IRB in the past year and upcoming years. And with that in mind, we would like to share with you some of the key audit triggers for transfer pricing audit. Right. The first one would be companies with record of persistent loss, especially more than 3 years. Those companies with 3 years or more at loss positions, are highly alert and under strong scrutinized by the IRB for transfer pricing. And the second trigger would be the company recorded low profit margins as compared to their peers, as compared to comparable companies under the same industry. And the third one would be the companies which recorded significant fluctuations in profit and loss in a period of time. Because the significance of fluctuations in profit and loss may indicate to the tax authority the unusual transactions or unusual pricing policies that would require further investigations from the IRB. The next one would be companies who recorded significant amounts of related party transactions. Right, based on the quantum of the related party transactions, the IRB can classify entities at high risk for transfer pricing audit. Or if company made various and excessive intra-group services to overseas related party. Right, excessive charge of intra-group services or excessive charge of royalty expenses are high-risk transactions because the IRB may see it as the profit shifting arrangement where Malaysian entity arrange the transaction to shift the profit out of the country to the overseas related party. And therefore, entities with a significant payment of intra-group services or royalty expenses would need to document the transactions carefully and comprehensively. The next trigger would be the drop in profit after the tax incentive period. It would indicate, the non-arm's length pricing policy of the entity and its related party to enjoy the tax incentive, and after the tax holiday ends, resulting from the non-arm's length price, the profit of the company drop. And last but not least, entities with transactions with tax haven entities like Singapore, BVI, Bermuda, all of those transactions would be likely under scrutinized by the tax authority for transfer pricing audit purposes. All right. So business would need to be aware of those key triggers and to take very proactive approach to measures the risk, the transfer pricing risk at your business, as well as to take relevant measures to mitigate the risk and document all of those transactions, intercompany transactions, thoroughly in your documentation. Right. And with that, I would like to move on to part 2 of the session today. We'll be discussing in details about how to document the transfer pricing report for the financial year 2020 in the light of COVID-19 and in the light of the new time deadline. Right. Because of the pandemic, it made significant impact to business globally. And under the OECD guideline, they list out 4 priority issues for transfer pricing implications that taxpayers need to address. And the first one would be the comparability analysis. The comparability analysis is an analysis where you compare the tax party results with the comparable company to identify if there is any gap between the tax party results and the comparable company's results, and to explain why the gap has happened, and to justify whether the gap is resulting from the external factor or the pricing issues. And the second priority is the consideration given to the loss-making entity. Because of the COVID-19 pandemic, a lot of business recorded in the loss position. And it is our priority to defend our loss positions for transfer pricing purposes. And also we need to discuss about the allocations of the specific costs due to the COVID-19. The third one would be the government assistance programs, and it impacts, if any, to the related party transactions. And the fourth one would be the advanced pricing agreement. We'll be discussing about the RB's positions, about the existing APA, and about the APA that is under negotiation step. Let's move on to the first priority. We're talking about the compatibility analysis. As we mentioned earlier, the purpose of this compatibility analysis is to justify why the tax party results is not in line with the market. It's not in line with the comparable companies, right? And in order to do so, in order to justify the position, we need to carry out additional analysis. And the analysis that we list out here are our recommended analysis that could be used by business to support the position. Number one would be the change in sales volume. You can make analysis of sales volume change compared between the year 2020 and past year 2019 to indicate that because of the drop in the demand in the market, then it leads to the drop in sales volume. It means that the factor affecting your financial results is the sales volume, but not the price, right? So the key priority or consideration here when you perform your comparability analysis is to justify that the price still be at arm's length. However, because of the other economic factors, it affects your financial results. And the second analysis that you can prepare is the change in capacity utilization. It applicable to manufacturing entities, right? because during the year 2020, there was disruptions in human resources, in labor force, in a supply chain. Your supplier or your customer are not able to perform as they're supposed to be. So therefore, the capacity utilizations of your business have been affected. And you need to document and analyze the change in capacity utilizations due to the COVID-19 impact in the analysis, right? To indicate to the authority that because of the change in capacity utilizations that lead to the change in, or it lowered the financial results. The third analysis taxpayers can prepare is the analysis on the incrementals or exceptional costs that incur due to the COVID-19, right? Because of the COVID-19 pandemic, business may need to incur exceptional costs for like logistics, for labor supplies, so on and so forth. And for the purpose of compatibility analysis, you need to identify and quantify the costs that additionally or extraordinarily incurred due to the COVID-19 pandemic. Right. And the fourth analysis taxpayers could do is a comparison between the budgeted and the actual financial data, right? By comparing the budgeted or the forecasted data with the actual one, you can identify the factors that affecting your business result and would help you to move on to the next step where we'll discuss to help you how to eliminate those factors. So the four analysis that we discussed just now is to help you to identify the factors that are affecting your financial results due to the COVID-19, right? And based on those analysis, you can analyze those effects on your profitability as well as those effects on the comparable companies' profitability. All right, and from that, you can make a comparison and to eliminate the impact of the COVID-19 pandemic affecting your business. So with that in mind, we'll move on to the approach on how you can use the factors that we identify in the first place in your financial adjustment, right? So the option, there are three options that business can take, and business can opt to take more than one options that are practical and applicable to their business. Option one is for business to adjust the result of the business itself, the tested party itself, by way of eliminating all the impact of the factors that identified. Let's say the factor that we identify is the drop in sales volume of 50%. All right, so we adjust the tested party by eliminating the impact of the drop in sales volume by 50%. What would be the result, the adjusted result, if we eliminate those sales volume? Then we compare that adjusted result with the comparable company, right? So after the adjustment, after the first step, after the adjustment, the adjusted result would be better, right? And we compare the after adjusted result with the comparable company to see whether the adjusted result can fall within the market range. It is the first option. The second option is to adjust the comparable company's financial data. All right, but before you can adjust the comparable company factor, you would need to determine the actual impact of the COVID-19 on the tested party. The same process as we mentioned in the first slide. right? For example, the actual impact of COVID-19 would be on the sales, 50% drop in sales, 50% drop in gross profit, or 50% increase in operating expenses, for example. Then you apply those impact into the comparable companies. For example, you adjust the comparable company with the impact of reductions 50% in sales or 50% in gross profit, and you see what would be the result look like. Right? With that steps, they would likely lead to a lower range of the comparable company's results. Right? And you would compare the actual tested party results with the adjusted results of the comparable company. And option 3, even though it's not ideal, but is still supportive and doable, is that you compare the tested party results with the comparable companies over a longer period of time. For example, 5 years, 7 years, or more. Right. So with 3 options in hand, business can choose to utilize either options or combinations of 2 or more options to support the positions, the financial results for 2020 for your business. Right. And the second priorities that we want to highlight here is the loss-making entities and the allocations of the COVID-19 costs. Again, the allocations of loss or the or profit between related parties must be based on the allocation of risk between parties, because it's based on the an economic concept that higher risk would have higher expected return or loss. Lower risk would have lower expected return or losses. So therefore, in order to share the loss between your business and its related party, business would need to go back to the allocation of risk to determine the allocation of loss. And the next considerations about the allocations of specific costs due to the COVID-19 should be based on the assessment of the comparable company or independent enterprises under the comparable circumstances. For example, we can see in the market that banks now offer lower interest rate to the to individuals and to business during this COVID-19 period. Right, it is the market dealings. It is the actions taken by independent bank and individuals and business. And with observations in mind, business or entities within one group may want to consider lower the interest rate given to the related party as well. Right. So the what taxpayers can do is to observe how is the independent parties dealing in the market under the comparable circumstances, to consider to either allocate a cost or revise the transfer pricing under the specific transactions. And the third one we want to highlight here is that business may want to look into the intercompany agreement again to see whether the agreement have any force majeure clauses where business can utilize to revoke or revise the intercompany agreement. And for the loss-making entities, we recommend to business to prepare special factor analysis, and this special factor analysis should cover 3 analyses. For example, the contractual analysis that lists out all legal terms and rationales why the companies is having the loss positions by review the contractual terms or obligations of each entities under the contract. Right. The second analysis should be the loss factor analysis. And as we discussed earlier, the first loss factor analysis, we need to focus on specific reasons for losses and focus on financial analysis after eliminating those specific factors. And the last analysis we recommended would be the segregated period analysis, where you divide into the period under review into three sub-period. Those could be COVID-19 affected period, transition period, and resumption period. And we will have a look at the spatial analysis for a example that we prepared here. For example, we have a full-fledged manufacturer entities sells goods to a limited risk distributor, so that the distributor can sell the goods to the local customer here. And under the normal year circumstances, the limited risk distributor was given a fixed profit at 5%. However, during the pandemic year, the budgeted or forecasted profit is about 2% at loss. With that forecasted figures in mind, the business may want to carry out three analyses, as we illustrated before: the contractual analysis to see if they can utilize any force majeure clause to get any compensations due to unforeseen crisis or circumstances, to require compensations from the full-fledged manufacturers for their loss. And secondly, they can carry out the loss factor analysis to analyze the factor affecting the drop in profit and making loss positions. It could be the significant drop in the market demand. And thirdly, the analysis on segregated period could draw additional support to the business to show that during the COVID-19 affected period, the drop in demand was 100%, is very severe. Under the transition period, the drop in demand was at 50%, and under the resumption period, is a drop in demand is at 10%. And it helped to explain the drop in sales and financial results. All right. And another considerations for the loss-making entities is whether we can use the loss-making comparable companies for our benchmarking purpose. In Malaysia, normally tax authority would reluctant to accept the loss-making comparable companies, but given the COVID-19 pandemic conditions, the tax authority is taking the positions like to accept it on case-by-case basis. Right. However, if the business can take efforts to make relevant financial adjustment to the tested party and to the comparable company, they may not need to use the loss-making comparable companies, because using a loss-making comparable company, it requires taxpayer to prepare argument and justification on why they want to include those loss-making comparable companies. Let's have a look at the example here. Right, we have the comparable analysis for 2018, 2019, and 2020. And there are 5 comparable companies have been selected for transfer pricing purposes. And in 2018, the median is 9%, and 2019, the median was 8%. Taxpayer results in 2018 and in 2019 was 10% and 9% respectively, and was concluded as to be seen as arm's length. However, for the year 2020, 3 comparable companies, namely like A, B, and D, dropped their profit and recorded loss positions, and made the median of the year 2020 became only a loss of 5%, and the taxpayer result was a loss of 3%. Questions are whether the IRB would accept the comparable A and B and D given their loss-making position, whether they accept it as a allowable comparable companies for benchmarking purpose. And the second question is to how to justify and support the loss-making position of the taxpayers at a loss of 3%. So the answers to questions whether the IRB would accept the loss-making comparable companies is to look into their functional compatibility. Right? If the company like A and B and D are still own the functional profile that are comparable to our tested party, and the loss is genuine loss due to the COVID-19 pandemic, then they may still be accepted as the comparable companies. Okay. And under the limited risk arrangement, we have seen a lot of companies in Malaysia operating under the limited risk arrangement, either as a manufacturer or distributor. So justifications as to whether limited risk distributor or manufacturer can incur loss need to be based on the detailed reviews of the related party arrangement and the allocations of risk between your business and the related party. Right. And here is the example of the limited risk operator. The same examples as for the loss-making positions for the limited risk distributor. So in order to support the loss-making position of the company, we will need to look into the allocation of risk between the limited risk distributor and the full-fledged manufacturers in the case. All right, and some arrangement can be made due to the consequence of the of COVID-19. For example, if we observe that in the market, the independent distributor can offer discount or can get discount from independent supplier, then those discount should be considered, right, to be given between related party suppliers and distributor. We will go through the next two priorities as like the government assistance and APA in the next couple of slides. In terms of the government assistance programs, it could be in a monetary or non-monetary program that the government gives direct or indirect to the taxpayers, and it may have some potential impact implications on the pricing of the control transactions. And for those impacts, taxpayer would need to document the details of the assistance program and the applicable impact on the price of the control transactions to the business, right? And the next priorities that may impact your business is the advanced pricing agreement. There are two types of conditions of the APAs that the tax authority want to make their positions. Number one is on the existing APAs. So the tax authority is taking the position that for existing APA, terms and conditions should be maintained, unless the conditions leading to the cancellations or provision of APA, such as a breach of the critical assumption. It may be arguable that the COVID-19 pandemic can be classified as a breach of critical assumptions, and it would trigger the cancellations or revision of APA. However, it would not apply automatically to the existing APA. Taxpayer would need to take efforts to prepare the analysis to justify the breach of the critical assumptions, and the tax authority would review the case based on the specific facts and circumstances and on a case-by-case basis. The second one would be the APA that's still under negotiation. For those APAs under negotiations, the OECD suggested that taxpayer and tax authority would need to adopt a flexible approach to take into account the current economic conditions, and meaning to say that in the APA, you can analyze the impact of the COVID-19 pandemic and the economic conditions of the year 2020, and from there you set out other terms and conditions of the APA to be agreeable by the tax authority, right? And those are the positions of the tax authority towards the APA, right? And with that, I would like to end my session here and would hand it over to Duff to share about the operating models for transfer pricing in Asia Pacific.
Thank you very much, Becky. So, just take you into the slideshow. Here we are. So, I'll now provide a brief overview of the typical operating models that multinationals may decide to operate in Asia, and the associated tax and transfer pricing issues. Most of you will be familiar with a transactional principal model, where the principal company located in a tax-advantaged jurisdictions like Singapore, Hong Kong, maybe KL. It functions as a sub-regional HQ, buying and selling product, booking revenue from those transactions, and essentially earning a portion of the residual profits for its regional coordination. Distributors may be structured as limited risk distributors, and manufacturers may operate as contract manufacturers or toll manufacturers, both of them operating on a more or less limited risk basis, and therefore earning low but stable returns. The intellectual property can be centralized in the principal or the regional principal company, with contract R&D providers perhaps being located elsewhere in the region. A variant of this is what's known as a non-transactional principal model, or a services principal model, whereby the principal company, again located in a tax-advantaged jurisdiction, provides value-added services and access to intellectual property for the group manufacturers and distributors in return for value-based service fees and royalties. In this type of model, the distributors and manufacturers operate more autonomously as profit centers, and product is sold directly from the manufacturers to the distributors, so it doesn't go through the principal company, hence the phrase non-transactional principal model. The activities of the principal in this case are limited to routine and non-routine services, development and management of intellectual property, and so on and so forth. Again, the principal, as I said, will be located in a tax-advantaged jurisdiction. And the greater the substance that and value add that you can demonstrate is provided by the principal company, the greater can be the profit that is can be justified as being made in that company, and the greater the benefit can be in terms of lower overall effective tax rate. So those are the two main models that many companies follow. Just looking at a traditional centralized business model may look something like this, although every company is set up slightly differently. And each of these areas, so manufacturing, warehousing, distribution, shared service center, etc., they will all have their own distinct transfer pricing issues that you need to be aware of. So first of all, let's look at head office and shared service center structures. So the provision of services is by a shared service center or call center, can even be by the head office. Provision of services to group companies. You need to look at it. Obviously, there's two sides to this type of transaction. There's two sides to every related party transaction. There's the service provider and the service recipient. So from the service provider perspective, how to price that service fee. First of all, there's the allocation of direct service costs to the individual service recipients, and that's the first step you need to go through. Then you look at your indirect service costs, indirect costs, and make an apportionment of those costs on a fair and reasonable basis, depending on the nature of the expense. So you may use, say, headcount for HR type expenses. For IT services, you may use the number of IP addresses, for example, that are being used by each of the service recipients. This is essentially a user pays principle. Once you have determined the cost base in respect of the services that have been provided, as a service provider, you need to make an arm's length profit. So you mark up that total cost base, but you only apply that markup on value add or non-pass-through costs. So that's from the service provider perspective. From the service recipient perspective, you obviously need to try to make sure that you achieve a tax deduction for those service fees being charged to you by the either shared service center or head office. You need to demonstrate a number of things. So first of all would be, are valuable benefits being received from the services being provided? Can you demonstrate that valuable benefits are being received? Are those benefits commensurate with the amount of the charge that has been made? Is it a reasonable fee for the services provided? If the answer this question, if the services are not received from the shared service center or the head office company, would the service recipients have to source those services from elsewhere, or carry out those services in-house? And ultimately, another question you need to ask as a service recipient: could you have derived those, received those services from a cheaper local alternative at the same or better quality and under similar terms and conditions? Often the answer to that is, well, no. But you need to go through that thought process and ultimately document that in your transfer pricing documentation. So As far as deductibility of those service charges for the is concerned, you need to provide evidence of the benefit derived from those services, and the benefit derived can be in terms of costs saved or income increased. Is the charge commensurate with the benefits received? You need to be able to provide a detailed breakdown of the cost base. Can be down to each individual invoice. Can you demonstrate that costs were actually incurred? Be prepared to support the allocation bases that you've used. Don't just simply apply a revenue-based allocation of indirect costs. Sometimes that's entirely appropriate, but it may be that a more scientific or a granular type of allocation basis could be used, like for HR services, for example. Make sure there is a comprehensive legal agreement in place governing the charging of services, and make sure that it is in its nature an arm's length type of agreement. So it's the type of agreement that would be entered into and agreed between independent parties. And of course, subject to the limits that Becky has described in Malaysia at least, make sure that you have comprehensive transfer pricing documentation in place to support not only the service provider perspective, to demonstrate that it's an arm's length charge, but also from the service recipient perspective. And in a typical multinational, you will find that there could be multiple service recipients for the one centralized service provider. So that the benefits of doing transfer pricing documentation and doing it well, the benefits can be significant because it may support your tax deductibility of the charge in multiple locations throughout the region. Okay. Now, procurement structures. Obviously, not every multinational will have these, but it's worth discussing. There are several ways that you can structure your procurement operations. There's the service model, whereby the procurement company performs only a coordination and support service type function for the procurement of goods by the principal. The principal enters into the contracts with the third-party suppliers, but the procurement company, the group procurement company, carries out a support service for the principal company. So the procurement company does not take ownership of materials and carries out and assumes a pretty low level of risks in the whole process. Typically, the service fee for the procurement company in this model is cost plus, and it's on its costs incurred in the provision of that service. So typically, some or all of its operating expenses. And typically, the markup is maybe around 7 to 12%. The second model, commission model. Again, the procurement company does not take title to the goods, but it carries out more activities and provides more value add to the principal. So each case is different, but typically provision of market intelligence to allow the principal company to source the best products at the best price, for example. Procurement company does not take ownership of the goods, as I mentioned, and again the risks are low, but the value add might be more considerable. In this commission type model, the revenue of the procurement company is based on a commission fee calculated as a percentage of the value of goods procured, and that can be benchmarked. There we go. Third one, buy-sell model. This is where the procurement company carries out more significant activities with a higher value add, such as, again, market intelligence, inventory management, manufacturing, management of the manufacturing process by the third-party suppliers, perhaps, performance of quality control procedures at third-party supplier premises, for example, management of finance, administration, logistics management. There's a whole range of things that could be carried out by the procurement company, but importantly, in this model, the procurement company takes ownership of the materials produced, purchased, and usually assumes inventory risk, foreign exchange risk, logistic risks. The transfer pricing policy for the sale of the goods to the principal by the procurement company, it's designed, the pricing is flexed in by reference to the savings achieved by the activities of the procurement company, but ultimately you benchmark the procurement company using operating margin as the profit level indicator, and typically the return or expected return would be at the lower end of the distributor spectrum. Now, manufacturing structures. This is a spectrum. Each case has to be looked at differently, but there are some comments that we can make. There are 3 options listed here, but again, as I said, every case needs to be looked at separately. First of all, option 1, assembly. That's where the assembler carries out routine and low risk activities, such as assembling products from components or semi-finished goods supplied by the principal, and then selling the finished goods or more finished goods back to the principal company. Should earn a low but stable profit, and typically that would be tested by way of transactional net margin method or potentially cost plus. Secondly, the contract manufacturing. A contract manufacturer processes raw materials and semi-finished goods that are supplied to it by the principal company, and then sells the resultant finished goods or more finished goods back to the principal. So its activities are provided under contract to the principal company. That's why it's called a contract manufacturer. It is similar to a toll manufacturer, but contract manufacturer takes title to the raw materials and work in progress, whereas a toll manufacturer purely carries out a processing service as a service. Contract manufacturer should earn a low but stable profit, tested on the basis of TNMM or potentially cost plus. Sometimes manufacturers are called contract manufacturers when they're not really. The example here is what a contract manufacturer should be. But if the so-called contract manufacturer is actually selling goods to third parties and is not carrying out a processing activity for only the principal, then it's a hybrid of a contract manufacturer and perhaps a full risk manufacturer. So you need to look at each case separately. I give that warning. Thirdly is a licensed manufacturer. In this model, the manufacturing company purchases raw materials and other inputs into the manufacturing process, mainly from third parties. It then processes them, potentially under license of manufacturing know-how provided by the principal company, and sells those finished goods mainly to third parties. The activities here are certainly more complex, and the company operates pretty much as a profit center, bearing capacity utilization and other key business risks. It should earn certainly a higher overall profit over a full economic cycle, and you do find that the profitability should fluctuate more because it's carrying out more activities bearing more significant risks. You test it on the basis of TNMM or cost plus against independent comparable manufacturing companies. If there is a royalty paid by the manufacturing company to the principal for the use of manufacturing know-how, you can test that royalty by way of comparable uncontrolled price method using specialist databases, and we do that pretty much every day of the week. Lastly, we're going to have a quick look at distribution structures. The sales agent model, first up, this is where the sales agent does not take title to the goods, but it carries out relatively limited sales support activities to facilitate the sales that are actually made by the principal to third-party customers. The sales agent receives a cost-plus service fee or potentially a commission on the sales made by the principal company, sufficient for it to earn an arm's length net margin. Because the activities are fairly routine, limited, that net margin should be low but stable. You can check the arm's length nature of the sales agency fee by way of potentially cost plus transactional net margin method, looking at net cost plus markup at the net margin level, or potentially cut method if you can find comparable data of comparable companies out there, or comparable transactions out there, either internally or externally. So it's not beyond the realms of possibility, but it is quite unusual. Secondly, buy-sell distributor. This takes title to the goods, bears significant risks, and carries out more functionally intense activities to generate the sales to the third-party customers. So we're talking about marketing activities, logistics management, and other such things. The buy-sell distributor receives a gross margin on the sales to the third-party customers, sufficient for it to earn an arm's length net margin, essentially. And that, again, should fluctuate more significantly because it's bearing more risks. And overall, the profitability should be higher over a full economic cycle. You can check the arm's length nature of the gross and net profit by way of a resale price method or transactional net margin method analysis. Okay, so I will now hand over to Becky, who will take us through some Q&As and also some case studies that we have prepared for you.
Thank you very much, Jack. All right. All right. So for this Q&A sessions, we welcome all of the questions from the participants here. You please do drop us your questions in the Q&A icon, and we would love to address to your specific questions and concerns as much as we can during this session. Otherwise, we offer initial consultation sessions after the event if you would like to have separate discussions for your cases, right? And perhaps we will give you some time to prepare your questions and type your questions in the Q&A icon. And during that time, we would go through the some of the case that came into our notice and would like us to discuss the specific case for the interest of the all participants here, right? And the first case is about the chamber pricing adjustment. It's going to be made by limited risk distributor. Right, the models of the limited risk distributors have been discussed under the my session as well as Duff sessions. Just a key background again here is like the full-fledged manufacturer sells good to the limited risk distributor for the distributors to sell it to the local customers. And the two entities set out the pricing policies under which the limited risk distributors would earn a fixed profit return at 3% per year. However, the actual results of the limited distributors would vary based on year-on-year economic conditions. And for example, if they achieve the profit of 5%, then there will be a gap of 2% between the fixed profit given and the actual profit of positive 2%, right? Or in other cases where they achieve the results of only 1%, there would be 2% differences in terms of the actual results, lower than the fixed profit target return, right? So with those results where the actual amount is different with the targeted amount, the chamber pricing adjustment may be required, right? And these areas is a disputed areas under the Malaysian context, right? Especially the RB would have additional questions if it involves downward adjustment, right? Meaning that for example, the actual profit achieved at 5%, but the business make a downward adjustment to adjust it to the fixed profit return at 3%. It calls the downward adjustment, right? And if the tax payers is going in to enter the downward adjustment like this at the year-end, right, before it close the financial results, it would need to make the commercial considerations and justifications in the chamber pricing report to justify why the downward adjustments is defensible from the Malaysian chamber pricing perspective, right? And some considerations may need to take it into account could be to identify the specific issues on the supply chain management that warrants the Malaysian entity to make the downward adjustment, or if there is any financial risk assumed by the entity that help them to warrant the downward adjustment, or there is any group policies at the group level and supported by a proper benchmarking analysis to warrant the companies to have downward adjustment or to bear additional costs. So it all comes down to the identifications of factors in the supply chain or in the risk assumed by the business and its related parties. And the next case we want to discuss with you is about a company who wants to obtain new financing for working capitals, because during the COVID-19 pandemic, a lot of company having the working capital issues, and they one of the options for them is to obtain new financing. All right, and the case here is we have the headquarter company who provide or extend a loan to a subsidiary during the COVID-19 pandemic period. And the background of this loan is that prior to 2020, the COVID-19 year, the headquarter already provided a loan to the subsidiary company with an interest rate of, let's say, 8%. All right, and it is existing loan at 50 million ringgit at the interest rate of 8%. And the additional loan during the MCO period is like, let's say, it's 30 million ringgit in principle, and the headquarter need to set the interest rate for the additional loan, right? And as another background, the headquarter obtained the fund for the additional loan by getting the fund from the external bank at the 4.5%. And the 4.5% is really a lower rate as compared to the previous period, given that banks is offering lower interest rate during MCO period. All right, so question here is, what would be the interest to be applied for the additional loan? Whether it should be, free of charge at 0%, or 4.5%, which is equal to the cost of fund obtained by the headquarter from the bank, or 8%, which is equivalent to the previous interest rate, or any other interest rate should be applied, right? So we need to go back to the arm's length principle, and we are aware of a lot of domestic groups are giving loans to subsidiary for interest free of charge, and that is not in line with the arm's length principle. And the loan should be granted at the arm's length interest rate instead of free of charge. And have a closer look at the case. The 8% of the existing loan may not be relevant to the additional loan during the MCO period, given the differences in economic conditions of the existing loan and the additional loan. All right, so the 8% should not be relevant, right? The 0% should not be relevant as well. And for the 4.5%, take into account the cost of fund the headquarter obtained from the bank. It could be a reference point, right? Because it is the cost that the headquarter has able to get from the bank and his third-party independent dealings, right? So on top of the 4.5% interest rate, the headquarter may need to take into account their cost of handling the loan and taking additional risk of being the borrower, taking the risk towards the bank and taking the additional credit risk. And
yeah, Becky?
Sure.
Just a couple of comments on that. We can certainly benchmark also the margin that the parent company would achieve on top of that 4.5%. That is something that we have done a lot in the past. I guess there's a couple of other things as well. There's a lot of evidence of independent companies providing extended credit terms to enable companies, suppliers, for example, to stay in business, because it's worthwhile for them to provide extended credit terms to ensure that their suppliers remain in business, so they're protecting their supply chain. So there's evidence of that happening between independent parties. So that's one option that you can consider in getting through the MCO and COVID period. There's a risk also that if you do decide to apply 0% interest rate, that could be deemed to be equity as opposed to debt. And again, there's plenty of examples of independent companies pumping in more equity in order to keep group, other companies afloat. So that's a risk if you choose to make interest-free loans, as I'm sure many people would be aware. But each case needs to be looked at on its own specific facts, and as you say, 8% is not going to be the right answer in this case. But it could be 4.5% plus a margin for arranging that finance.
Right. Thanks a lot for the comments, Douglas. And just additional comments to that. In Malaysia, as we adopted the earnings stripping rules for the financial assistance transactions, so taxpayer also need to be aware of the earnings stripping rules and the restrictions of the interest expenses that exceed 500,000 ringgit in a year of assessments will be restricted to 20% of the tax EBITDA for the year. So meaning that if the tax EBITDA for that year of assessment is company having loss, so the tax EBITDA for the earnings stripping rules purpose would consider as 0, meaning that the interest expenses is not allowed to be deductible, right? So when we talk about financial assistance, Amsterdam principle is number one, and the second one is the earnings stripping rules that taxpayers need to be aware of. Right?
Yeah, you got to look at the intercompany agreement governing the finance as well, and is there a break clause in there for significant events? And if there is, then you need to be governed by that clause. That would justify a renegotiation of the interest rate, and you would also typically see that in an arm's length situation. So if your intercompany agreement doesn't have a clause like that, then it's possible that the tax authority will say, well, you would have a clause like that if it was an agreement between independent parties. Therefore, we will assume that there is one, and you should not be paying 8% interest. You should be paying something much lower. So there's a lot of issues thrown up by COVID.
Right. Okay. And with that, we will move on to the next case, or we address the questions from audience. Do we receive the questions just now, Douglas?
I don't believe so. I think people are being a little bit shy at asking questions, but as Becky says, please do either ask questions now or feel free to contact one or both of us after the event, and we'll be happy to field your questions. So I suggest we carry on to the next case study,
Right.
Becky.
Yeah. And the next case study,
Douglas and Becky, there are actually 2 questions that have been posted on the floor. So
All
the
right.
first question is, what happens if clients request tax agent to furnish IP docs upon request by IRB? And do we take on project given the 14 days timeline? I think perhaps either Becky or Doug can give us some lights on that.
Well,
question.
The simple answer is that 14 days is not going to be enough to produce any sort of decent transfer pricing documentation, really. The client should be prepared and should have that documentation already in place, but we live in the real world and that doesn't always happen. True. 14 days is too short, so request an extension to provide said documentation, and hopefully and Becky, you might comment on this. Hopefully the IRB will be nice to you and grant an extension, which will give you a decent amount of time to put together some transfer pricing documentation. Is that likely to be accepted, that sort of request for extension? How likely is it, Becky?
Right. Yep. So the likelihood of the IRB would accept the request for extensions based on several factors. One of it would be how you file your tax return. Did you indicate that you have prepared the documentation? You tick the box. You say yes. Then the IRB would argue that you told us that you prepared it. So why now you would need more time to furnish the documentation that you already prepared to us?
Yeah.
Right. Other factors is the timings of the request, right? The pandemic, the tax authority would normally give extensions to the tax filing returns deadlines. So with that, the deadlines for preparing the documentation has been already extended, right? Meaning that the taxpayer already have time to prepare and finish up the documentation. So, so the extensions will be considered on case-by-case basis. But you need to take into account the factors that I just discussed.
Sure. I guess it also comes down to the relationship you have with your tax officer. If you have been a good corporate citizen in the past and you have a good reputation, they're more likely to be accommodating to requests such as that in the light of working from home, don't have access to files, etc., etc., etc.
Right.
Certainly, a big no-no would be ticking on your return that you have documentation in place and then mysteriously not be able to find it on and provision and provide it at 14-day notice. You can't do that.
Right.
Summer, were there any other questions?
Second question with regard to slide number 16. What if gross income is under RM 25 million and RPT transaction is more than RM 15 million? Is that falling under full or limited TPD? That's the question from the floor.
Right. Right. Was the gross income exceeding 25 million and the related party transactions exceeding 15 million ringgit, then business are required to prepare a full documentation, right? If the gross income is below and the related party transactions is below the threshold, the business can opt to prepare the limited version. Right. So the bigger size and the higher quantums of transactions, the more details of the documentation you are required.
Yeah. And what if the revenue is below the threshold, but the transactions are above the threshold?
So the way it regulated in the regulation is the and conditions. So when the two conditions met, then you are required to prepare the full documentations.
Okay. Okay.
I think that's it for the questions so far. You guys
Becky,
can continue.
Did we have another? There's another case study, I believe.
Sure. We'll continue with the case study. This case study is about a company obtain extended trade financing. All right. Company A and Company B are related, right? And under a normal credit term, Company A sells goods to company B and under the credit terms of 30 days, right? And late payment interest would be imposed at 5% after the 30 days normal credit terms, right? And then during the MCO period, company B experiencing the cash flows issues and would ask for the extended credit terms, right? And the company agreed to extend the credit terms to 180 days, which is like a 6 months period, right? The question here is whether the company A is allowed to impose the late payment interest of 5%. Or not at all, because of the extensions is already granted, right? So it's the rules of terms, deferments of payments for outstanding trade balances extended beyond a reasonable credit terms may give rise to transfer pricing implications, right? So with this case, what we would need to do is to look into the independent third-party dealings in the market within the same industries, and to see what we see as the credit terms that is given a extensions between independent parties, right? If those information is available in the market, right? Let's say 180 days or less, not 6 months, 3 months, 90 days is given in the market, and the information is available to your business and with the parties, then we may consider as it is the market practice for extending trade credit terms, trade financings to parties during the COVID-19 time. All right. So any extensions beyond what we observe in the marketplace, beyond the reasonable credit terms, would require entities to prepare justifications. All right.
Yeah. It comes down to the availability of information in the public domain.
Correct.
It may be unlikely that you could find that sort of information. There may be anecdotal type information that you could access from say the press or trade associations, things like that. So you might have to rely on qualitative arguments that under the terms of the agreement, a negotiation took place, and it was decided by negotiation that these extended credit terms could be provided because of the exceptional circumstances of COVID, and have all of those negotiations documented, minuted if necessary at board level, so that you can explain to the tax office at a future point in time what lay behind the decision, and that it was driven by commercial factors, not transfer pricing.
Right.
There's another element as well. The provision of extended credit terms can lead to a blowout in your accounts payable and accounts receivable on the other side of the transaction. So as something to bear in mind in your benchmarking, it may be possible to eliminate the impact of that by carrying out working capital adjustments to amend the interquartile range that you're being benchmarked against. Something to bear in mind. Can have a significant impact.
Correct. Right. So with that, we would move on to our next case is about the intercompany service charges. Right. The case is where a headquarter company provide management services to various subsidiaries, A, B, and C. And during the normal years, the headquarter would charge the monthly management fee of 3,000 ringgit to each entity. right? The entire 300,000 ringgit for 3 entities, meaning that 100,000 for each entity. And during the MCO period, and because of the disruptions in the supply chain and labor force, all those factors affecting the actual deliverables of the services, and the scope of services limited to only accounting and HR services are actually delivered, right? And the question here is whether the subsidiary A, B, and C continue to pay the entire amount, 100,000 ringgit per month, to the headquarters. Whether those service charge meet the benefit test during the MCO period, right? And the question here is another issue here is about the actual service render, right? Under normal circumstances, a lot of services actually render vary from HR, accounting, R&D, procurement, marketing. But the actual service delivered during the period was limited, right? So the question that both services actually renders and benefit tests need to be addressed, all right? And based on the actual service render by the service provider, and based on the actual benefit received by the recipient of the case here, entities need to consider to pay proportions to the entire amount of 100,000 K based on the allocations of service actual renders and allocations of benefit actually received by the recipient during the period, right? Meaning to say that the entire charge of 100,000 per month during the period, the MCO period, is hardly justifiable by way of looking at the service render and the benefit test, right? So business or group have this kind of arrangement would need to go through the intercompany service agreement again and to charge based on the actual service render, not only on the agreed amount for the totals, all kind of services.
It's conceivable that there will be more services being provided by head office to subsidiaries to support them through the business upheaval. So you have to look at the facts and circumstances of each case, and it may be that some services are not provided, but others are provided that may or may not be covered by the existing legal agreement. So you need to look at that pretty carefully to see what services are to be provided, and is there a break clause in there to cover something that a once in a 100-year pandemic? Perhaps unlikely, but you need to look at it carefully to see if, as you say, Becky, were services provided, was there benefits received, and are the charges actually commensurate with the benefits received?
Right.
And yeah, it's a headache, but you need to go through that process and capture what you find on in appropriate documentation. You can expect questions will be raised at some point in time.
Right. Yes. And with that, we would like to summarize key takeaway of the case study that we discussed. Number one is on the arm's length principle, right? Intercompany transactions must adhere to the arm's length principle. Pre-COVID time or during COVID time or post-COVID time. So arm's length principles is still the number one principle to refer to when you want to set the price for your control transactions, right? The second is about the transfer pricing method. There are 5 methods that business can choose from, right? So business would need to take efforts to consider all five possible methods and select the most appropriate one to the transactions. And the third one for the benefit test for specifically for the intragroup services transactions, because we have observed that in Malaysian's context, the benefit test and the reasonableness of the benefit received by the service recipient has not been taken care of enough, and oftentimes is missed out from the documentations. So we would like to take this opportunity to highlight to the business who have intercompany service charge transactions. You may want to document the benefit test in your documentation, right? And the fourth one would be to maintain the transfer pricing documentations at the end of the year, right? Within the timeline of preparing your tax filing return. The documentation is first line of defense for the transfer pricing audit, and also it become a penalty protection for you from now on, 2021 onward, because having this, you can pass the the penalties for not preparing the documentations. So care and efforts should be made to maintain the documentation in place, especially this year onward. And the last one would be the COVID-19 specific risk and analysis. As we discussed over during this webinar, COVID-19 created a significant impact to the business and the financial results. And the identifications of the specific factors of the COVID-19 affecting your business need to be documented, because these factors may vary from one business to another, right? And the tax authority would not accept the overall explanation that because of the COVID-19, my financial result is negatively impacted. It's not sufficient. It's not reliable enough. So specific factors that we indicated in the webinar is important, and your business would need to define and quantify those factors impacting to your business for the year 2020. That would make your support to your positions in the documentations for transfer pricing purpose.
Certainly, I would echo that. We're finding quite a lot of companies have done rather well out of COVID. Others have done very badly. So it's very specific to the industry and very specific to a particular company. So each company needs to look at their own facts and circumstances carefully. There was a question about will we charge higher fee for TP study for 2020, where special analysis is required? Short answer is, well, yes, because there's more work involved, but there's two elements to it. First is you could include a qualitative only analysis of the impact of COVID on from a macroeconomic perspective, but then looking at your industry, and then looking at, from a qualitative perspective, your company. So describe how it has impacted your business. That's a qualitative analysis, and that's fairly high level. The ultimate solution is to carry out a quantitative analysis. So you try to make adjustments, as Becky had in her presentation, the three options, 1, 2, and 3. Option 1 is probably the better one of the three. So trying to identify the quantitative impact of COVID on your particular P&L and eliminate the impact of COVID on your results. That's a fairly well-known routine type of exercise that you do in a transfer pricing analysis. You identify exceptional income and expenses and try to eliminate them from the financial analysis of your results, and then compare your net result to the result of the comparable companies, which, bear in mind, would be from an earlier period pre-COVID. So that quantitative analysis, that is more detailed and would obviously cost more. So it depends on your risk. If you have a significant risk, if you're a large company and incurred a significant loss, and you think it's highly likely that the IRB or another tax authority, if we're talking about a different jurisdiction, highly likely that you will be challenged and receive an adjustment, then it's worthwhile spending a bit more money now to protect yourself from future challenges. Okay, there was one other question. Hi, is a cost plus markup policy appropriate for R&D services? Short answer is usually yes. If it is indeed limited risk contract R&D services being provided by an R&D center, then if that is truly the nature of those services, then yes, it would normally be on a cost plus basis. The issue is, do you have the legal agreements in place? Can you demonstrate that the R&D center is actually providing a limited risk, limited function service and is not actually generating ownership of the IP that it generates? You need to have somebody at the principal level directing the R&D activity, reviewing the outcome of the R&D services being provided, and telling the R&D service provider what to do next. So from a more fundamental perspective, you need to look at the structure of the principal and the contract R&D service provider to make sure that it is as you think. It needs to be borne out by the facts and circumstances and the economic substance. So there's a short answer and a long answer.
Right. And I just saw a new questions.
Yeah, for Indochina countries, if there is insufficient local comparables, which is how you do the benchmarking, that you need to look at each individual country really, because the practice does vary. If we're looking at well, Indochina, we're talking about Vietnam, Cambodia, Laos, etc. Vietnam, typically the comparables that would use to benchmark a Vietnamese company would be from the typically Greater China region, maybe ASEAN. And you do find Vietnamese comparable companies, but perhaps not a full set to justify your pricing. So you would then expand it to a larger geography that makes sense, and depending on the nature of the company that you're looking at and the industry, that might be Greater China, it might be ASEAN, or it might be all of APAC. But as long as you can demonstrate that you looked for local comparables, you've done your best. You've found insufficient local comparables. Most, if not all, tax authorities will accept regional comparables. But you need to go through the process and demonstrate that you have gone through that process. Hope that answers your question, Carol. As I said, please feel free to contact us after the event. Happy to have a call to discuss your specific facts and circumstances. Anything else, Becky?
I think we cover most of the points that we planned, and we also address the some of the questions that the audience have. I believe that there are more questions, but perhaps they want to have private discussions to
Sure.
discuss the specific cases. And we are good for now.
Okay. Thank you very much, everyone. I'll hand you over to Summer. Thank you, Carol. Summer, would you like to wrap up, or are we done here?
Thank you, guys. So to really quickly wrap up the webinar, thank you both, Douglas and Becky, for taking us through the presentation. And we've had some very good feedback from the audience. And thank you so much for attending the webinar. And we'll be sharing the webinar replay and presentation in around a week's time. And thank you so much all for coming in.
That's great. Thank you, everyone. Take care. We've been talking about FY 2020 as if it's a 1 year, but we're halfway through 2021. So this might hopefully not going to become the norm. Hopefully it is an outlier event.
All right. Thank you very much, everyone. Stay safe.
Yeah. Thank you very much.
All right.
Bye-bye.
Bye.